Well, today, Canada's Competition Bureau published the findings of a study it did into the country's competitive intensity over the past 2 decades. And it found a decline in that intensity across all of the indicators that it tracked. So which indicators raise a red flag, and where do we go with this information from here? Let's bring in Michael Osborne, chair of the Canadian Competition Practice with Cozen O'Connor. Michael, thanks so much for coming in today.
Great.
Appreciate
Great to be
it.
here, Jacqueline.
Really interesting report and a long one, too, full of graphs. We're going to go through a few of them here. But it looked at a few indicators, and one of them was concentration. So the idea that there would be a few firms, few big firms, earning a large share of revenue, and flagging that concentration has increased in industries that were concentrated already, and then increase in other industries as well. And I wonder how much of a concern that concentration should be.
Yeah, so concentration is one of the key indicators for the potential for there to be a problem with competition. The figure that they use, the HHI index, is very commonly used, especially in the US, but also in Canada. Essentially, what we're looking at is, how few firms have all the market share. The way that you calculate one of these is to take the market shares of all the firms and do the do to the power of 2, and so then you create an index that then of relatively small change will lead to a very large increase in the HHI. So it allows us to analyze that. These increases that we're seeing on this graph aren't that big.
Okay.
It does show that there are some sectors. What it's done is it's looked at the top, for example, 10% of the most concentrated industries and found that they've gone up a little bit. But because you're squaring the market shares, that, even 2 squared is 4, right? So an increase of 2 will give you 2% market share for one player will give you an increase of 4 on the HHI. So it can go up very quickly. So again, it shows some concern, but I wouldn't, make such a big deal of it.
It also looked at the entry and exit of companies in industries. So this idea that I suppose if you see an opportunity to compete somewhere, you're gonna want to get in on that market. And there's the graph that sort of illustrates what they saw. I wonder if you can give us a sense of how you interpret this one.
Yeah, so this is showing the effects of some of the economic crises that we've been through. For example, you'll see that there's the white line is exit and the blue line is entry. So you can see during the financial crisis, and really more after the financial crisis, we're seeing a lot of the 2008-2009 period. We're seeing a lot of exit, relatively less entry. During that time, businesses were exiting or merging because of failure. And so that shows that. It shows also a spike in exits in 2020. Again, firms that would seem failing because of the pandemic. But leaving that aside, we're not seeing massive differences in entry and exit. The trend line is not, well, it's hard to discern, frankly, and it doesn't seem that it's moving all that much. So again, some cause for concern, perhaps, but I'm not sure I'd make such a big deal of it.
Let's take a look at one more, the rank stability. So when companies are at the top ranked in their sort of industry, it looks like they're able to hold on to that ranking. And maybe you can give us a sense of what we're looking at here better.
Yeah, so the idea is that we're looking at the tendency of firms that are the top firms in whatever area you're talking about, whether it's technology or groceries or cars or anything, to stay at the top.
Yeah.
And they're finding that the rank stability has gone up. Now, why does that matter? And it does matter. Why it matters is that in a competitive environment, we expect people to be, it's a bit like sports, right? If the same team wins the Stanley Cup every single year, then you wonder how competitive the league is.
Right.
So you expect to see different teams winning in different years. You expect to see companies jostling for first and second place and replacing each other at the top of the heap.
There was one other one that I think you found interesting as well, and it was on efficiency of companies. Maybe, yeah, we're looking at that one now. And, it looks like the white line is the top 10% of companies getting less efficient. And maybe you might jump to a conclusion that it's companies in a leading position are able to not innovate, perhaps, or not be particularly efficient or not make efficiency gains. But can we take that away from this?
Well, that's a possible conclusion.
Yeah.
But what it's doing is it's measuring or trying to measure economies of scale. So, big organizations being more efficient because they're making more widgets or whatever, and they have, more efficient factories. And it does it by comparing the large firms with the small firms to see by how much they're more efficient. So that white line is telling us that the difference between the large firms' efficiency and the small firms' efficiency has gone down. That doesn't tell us that the large firms are less efficient. It's possible that that's what's going on. It's also possible that we're seeing increases in efficiency in smaller firms due to technology or what have you.
So what should we take away from all of this? It's interesting. I felt like I took a bit of an economics class when I was looking through the report. And I do like going through the graphs and trying to understand what competition is like in this country. And it makes you think, will we attract other businesses to this country if we're sending signals that we're not competitive? As the Bureau suggests, competition is good for consumers. It means that, companies will be trying to innovate, trying to maybe offer lower prices so that they win consumers over. But what do you think we can do with this, with these findings?
So it's a good first step. The Bureau is bringing to the public's attention, and it's a very worthy thing to do, that there are potential issues. It's as though you went to your doctor for your physical and you get your blood work and your blood pressure and all that. But then what do you do, right? You need to compare your blood pressure with what you expect for your age and your blood work with what's normal for your age and so on.
Yeah.
So that's what we need to do. We need to then ask, well, what's happening in the rest of the world? How do we stack up against other economies that are our peers? And then we have to ask, okay, what do we do to make our economy more efficient, more attractive for investment? And the Bureau has been promoting, and again, a very worthy thing, the idea that we should look at government regulations and identify how we can fine-tune them in order to reduce their impact. Because sometimes, for example, government regulations make it harder for people to enter the economy, to enter a market.
Right.
And that reduces competition. So that's what we do next. This is a good first step.
It's sort of, do you think it is setting the stage for something, pushing for some sort of bigger change?
So clearly the Bureau hopes so.
Yeah.
Competition is a hot topic right now, which is great. So we should seize the moment and do the rest of the work to figure out, okay, what do we do with all of these graphs? What policy changes do these graphs lead to?